听见资本本期视频为您带来的是大摩根士丹利在3月27日闭门会的关键内容。亚洲市场的最新动态来了，从中国经济的小惊喜到韩国政局的动荡，再到印度尼西亚银行的压力测试，这些变化可能直接影响你的投资选择。今天咱们就来聊聊这些热点背后的机会和风险。先看中国经济数据超预期，第一季度 GDP 追踪到 5.4%， 全年预测也从 4% 掉到 4.5%。科技行业的资本支出爆发是个大亮点，特别是 AI 相关的投入翻倍增长，但别高兴太早。关税压力和消费刺激减弱，可能让增长在二季度开始放缓。通缩风险还没走远，7月下旬的政治局会议可能会推出更多财政刺激，比如扩大以旧换新计划，但能不能顶住外部压力，还得看政策落地。再说中国股市 ，MSCI 中国指数终于打破13个季度盈利低迷，第4季度超出预期 8%， 市场信心回暖，目标价上调 8% 到 9%点。不过中美关系紧张和关税不确定性还是个隐患，投资者得留个心眼，别被短期涨势冲昏头。转向韩国，政治风波不断，总理复职反对党领袖无罪判决，总统弹劾案还悬而未决，加上卖空禁令即将解除，市场波动少不了。短期看不清方向，但中期可能有反弹空间，尤其等政治和关税局势明朗后，资金或许会回流。最后说，印度尼西亚银行业在熊市压力测试下暴露风险，国有企业估值可能还有 16%到 60% 的下行空间。新政府政策不明朗，外资也在观望。私营银行像 BCA 更抗跌，但高股息派息率背后，资本缓冲能不能撑住是个问题。这些市场的起伏对你的钱袋子是机会还是雷区？接下来是英文会议的全部内容。如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Good morning and good afternoon, everyone. It is March 27, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of the press. If you are a member of the press, please log off and reach out separately. Please also note that this webcast and your questions may be recorded. Today we have Robin Xing, Chief China Economist, Chloe Liu, China Equity Strategist, Jun Sok, South Korea Equity Strategist and Head of Korea Financial Research, and lastly, we have Selvi Jusman, ASEAN Financial Analyst. During this session, you can send us questions at any time from the Ask a Question text box. So Robin and team, they have revised up their China GDP outlook, and Laura and Chloe from strategy team have also revised up their China index targets. So let me invite them to talk about the rationale and latest thoughts. Over to you, Robin.
Thank you, Crystal. Morning. So on Chinese economy, the mood is definitely improving. We have been revising up our GDP forecast from 4% to 4.5% for this year, based on two drivers. First, Q1 came in much stronger than most people expected, based on the first 2 months and the high frequency data we track in March. First quarter GDP is tracking at 5.4%, thanks to the front-loaded exports ahead of tariff risks. This stimulus, which is also front-loaded in Q1, local government got debt relief program, infrastructure spending is accelerating, and the consumer goods got a boost from the trade-in programs. All of these are showing stronger than expected start of the year. Plus, I think something more meaningful or slightly more sustainable is the return of animal spirit in the tech sector. Our estimate shows the capex momentum from advanced manufacturing, from AI adoption is surging. For top 5 hyperscalers, the AI capex this year will arrive and reach about 400 billion yuan, nearly doubled from last year's level. And if you put things like advanced manufacturing, humanoid robots, self-driving cars together, there is also stronger than expected capex momentum. With these two drivers, we have been revising up our GDP forecast. But here's the catch. We still expect headwinds going forward, and the sequential growth in China may soften a bit from second quarter onwards. If you remember the two drivers we mentioned for the upgrade, that's also going to be the payback going forward. payback from front-loaded exports. Now the export orders are showing some weakness, given the tariff impact cumulatively will start to kick in maybe by May or June. And also the consumer goods trading, the local debt relief program, they work probably best in the first few months, but after a few months, you will see its impact on growth will start to fade. That's why we still keep our full-year growth 4.5%. That's below government official target of 5%. And more importantly, our forecast on nominal GDP and the GDP deflator remains quite cautious. Both are below consensus, forecasting 3.6% nominal GDP growth for this year and a minus 0.9% GDP deflator. In a nutshell, China is still fighting deflation. There is no decisive reflation yet. Now, the next question is about, okay, given all these revisions, what would the Chinese policymakers do? Now, just after the NPC session, usually they just try to focus on execution, delivering what they said in the NPC. For next policy event to trigger something larger than expected, like larger than NPC package, we think that would be in late July. Late July Policy Bureau meeting, that's the event they can decide if they need to set aside more fiscal stimulus for consumer side for, say, trade-in program being expanded or launching a nationwide fertility subsidy program. This will be likely discussed with reviewing second quarter data. And if that cumulative effect of tariff is there, sequential growth is softening, housing lost some momentum, we do think it's possible by late July, they will try to expand the program on consumer trading or even expand that to cover certain services sector. Meanwhile, try to launch that nationwide fertility subsidy program. Right now, only 2 small cities are doing that. If you apply what they are doing in Inner Mongolia or Zhejiang nationwide, the first year subsidy could be around 50 billion to 100 billion yuan. It's still modest, but that's very positive, symbolic signal for the market on China is trying to address the population issue. Now, that's about the next policy event. What about the renminbi exchange rate, given all this tariff news? Our view on U.S. tariffs on China is, if you look at the U.S. tariff strategies, it could vary by country. They are talking about tariff against multiple countries, but certain tariffs are for negotiation. They could introduce targeted tariffs on cars, on Europe, and also on certain Southeast Asia countries due to the tariff imbalance. That's the April 2nd timeline everyone is watching for. But a lot of these tariffs are either targeted, small, or they can be negotiated down. However, the U.S. tariff on China could be stickier, higher, and it's harder to negotiate down. The de-escalation pathway between U.S. and China would be much narrower than the U.S. relationship with other countries. So right now we have 20% cumulative new tariff on China. That's going to save and knock about 0.6 percentage point GDP growth on China. And going forward, there is definitely risk of further escalation. And despite China is probably less sensitive to tariffs than 6 years ago, we still think tariffs will have some impact on Chinese exports, investment, and growth. And that's why, while renminbi has been holding up much stronger than people thought, we believe by second half of this year, when these headwinds on growth means sequential momentum were likely to slow, payback from export front loading will emerge, the PBOC could give away some control on the exchange rate in return for domestic monetary loosening. So we still expect by second half of this year, the PBOC has room to cut rates, cut RRR. Meanwhile, the renminbi could moderately depreciate against the dollar, despite the current strength. So that's our view on the growth revision. The mood is improving. There is a bright spot in the tech sector. with the return of animal spirit evidenced by the capex plan. But on the household consumption, on the broader economic recovery is not enough. And we think the next policy event will be in late July. After any downside surprise materialize, China could step up the consumer subsidy and the fertility support programs. With that, I will stop here, hand over back to Crystal.
Thank you so much, Robin. And then let me invite Chloe here to share the market views.
Thank you, Crystal. So for the China equity strategy side, we raised our China price target this week again. So our new price target for the Hang Seng Index, MSCI China, and CSI 300 implies 8 to 9% upside from here. And this is mainly driven by three reasons. Firstly, we see some green shoots on the 4Q earnings so far, and also on the ERB, the earnings revision brief. This is after we are seeing 13 consecutive quarterly earnings miss. So finally, we are seeing some green shoots on the earnings side. And secondly is we see a re-rating upside for MSCI China, particularly relative to the MSCI EM market. And certainly is that, just as Robin mentioned, our macro teams improved the forecast for the GDP and the CNY strength. The currency strength serves as an important factor for the Chinese equities, especially for the offshore market. This is because the foreign investor funding costs are usually in US dollar terms. So a relatively stronger currency will be a positive catalyst for an asset allocation perspective. So if we're looking at the 4Q results so far, MSCI China is having the first earnings beat after 13 consecutive quarterly earnings miss. The 4Q earnings showed an 8% net beat for MSCI China on both number of companies and weighted market cap. This is after 3.5 years of earnings miss. And compared to other regions, China also stood at a very good position. It's at the second best earnings beat, just after Japan at 14% beat, but much better than MSCI EM at 0.8% beat and S&P 500 at 1.3% beat. And the many beats coming from the sectors like financials, internet, high-end manufacturing, industrials, and IT so far. And also on the earnings estimate revision brief, the ERB, we see MSCI China and Europe are picking up rapidly with an uptrend, while for S&P 500, they are trading down significantly. And also on the valuation side, we think MSCI China can trade on par versus the EM with two reasons. First, the MSCI China's earnings and also the consensus estimate revisions are on a better trend than MSCI EM. And secondly, the Hong Kong market has a southbound support. The year-to-date southbound net inflow reached $50 billion. This is already 50% of the 2024 full-year level. And the southbound has already contributed to around 25 to 30% of daily Hong Kong market turnover right now. And if we look at the valuation, the MSCI China is trading at around 11.4 times 12 months forward PE versus MSCI EM at 12.3 times PE. Lastly is on the market key concerns. We think there are still concerns on the uncertainty of the US-China relations, particularly on the tariff risk and the potential investment restriction uncertainties. We would like to highlight that on the tariff side, China's position is not worsened compared to the expectation set up in the year beginning. Because even before Trump was elected, he has been talking about around 50% tariff on China. But at this time, we see actually a lot of more emerging markets will also be hit by the potential tariff hike. And also, if we look at the MSCI China's direct revenue exposure to US, it's less than 3%, and much lower than the board EM at 13%. For investors who are really concerned on the US-China tensions, we think that Asia may be a better place to concentrate the portfolio. But we would also like to highlight that for the non-US investors, if we look at the historical examples, the potential investment restrictions, etc., actually provides a very good opportunities to buy in deep. as long as the company fundamentals remains intact. The previous examples include like Tencent, CATL, and also China Mobile. When they were acted into the sanction list, etc., actually they see very good opportunities to buy in deep into these companies. Another market concern is on the macro drag and also potential growth slowdown from the second quarter of this year. Currently, we see the recovery on the ROE earnings and also on the FAI data. This shows stronger momentum among the AI and the adoption-related sectors. So we would continue to recommend overweight these sectors while we're still waiting for a more broader-based improvement. With that, I will stop here and pass it back to Crystal.
Thank you very much, Chloe. And then let me just call out June here to see whether he has connected.
Yes, I'm here. Can you hear me?
Yes, we can. So we'll just invite you in a second to walk through the latest market views. And because there's a lot of things to follow for Korean equities with the April 2nd around the corner, the expected lifting of the short sell ban, and a lot of domestic elements. So yeah, without further ado, I'll pass it to you, June.
Yes, thank you very much, Crystal. So, March has been a busy month in many ways. And we've used the March to come in like a lion and out like a lamb to be kind of the motto for the month. And we have seen some events play out right now. And one of the main ones is the court case for Prime Minister Han Duck-soo. He was reinstated on Monday. And there was also the case related to Mr. J.M. Lee, the opposition leader. And yesterday, the first verdict for him was guilty with 1 year imprisonment and 2 years probation. But yesterday, the verdict was for not guilty. And the importance of these cases is because, first of all, Prime Minister Han Duck-soo is now back in office as the acting president, and we're now seeing him actually taking charge on that. And also for Mr. J.M. Lee, there are issues if he is found guilty on any kind of charges, because then you can't go for public office. But with this, we have to wait for probably a Supreme Court ruling, but it does kind of open up the fact that if there is an impeachment, there could be he could run for office. So the next thing to look for is obviously President Yoon's impeachment case, which does seem to have been delayed to April. So we'll have to wait for that, but that's really kind of the key event that needs to happen on the political end. And if the impeachment is to be approved, then there will be a presidential election within 60 days of that day. If he is not, then he will be reinstated. So certainly, I think still a lot to look for in April. And the other, question that obviously we're getting is on the short sell ban lifting, which is expected for March 31st, Monday next week. And our, view on the short sell ban lifting has been that generally, if you look back at the cases, for example, in the first and second short sell ban lifting, which is more similar to the current situation, is that at that time we were kind of in either late cycle or an early cycle for the market, and also valuations weren't really that high either. And we're kind of in, I think, right now on a cycle basis, probably in the latter part of late cycle, and looking to see where, when we actually get to early cycle. So that's where we stand. So that's one of the findings that we made. The second is that, we do expect a lot more activity, especially from the foreign investors in the midterm. There could be volatility in the near term because of the uncertainty related to the political situation and also the tariffs. But in terms of the midterm, as we will get through this at some point, we do expect more liquidity and more activity, which should also increase the number of stocks that do have better daily volumes. We're, I think, kind of looking into the same situation that we saw, again, in the first and second short sell ban lifting. The third finding is that, and I think this is also important, is that's how the retail investors kind of respond here. And I think the change that we've seen recently, obviously, is a lot of the retail investors are investing overseas, and U.S. is one of the key markets. But recently we have seen some movement to actually the Chinese or the Hong Kong market, and some of the money coming back to Korea also. So that's the other thing to follow, I think, in terms of the short seller band lifting. So in terms of just kind of positioning, how to look at the market right now and what subsectors do look more attractive and what looks a little less attractive here. So we actually did some screens, and what we used was we looked at the valuation expansion that was seen in the past 6 months, and also the 2025 consensus net profit revision. And based on that, we find that the sectors that seem to be subsectors that's more pressured is going to be potentially the metals, the non-ferrous metal side, display, the IT hardware, shipbuilding, and semiconductors. While on the other end, we see software, utilities, banks, transportation, staples, autos, and telcos kind of being on the more the positive side. So it's not very different to where we have our sector allocation, but we also did recently another screening where we used our buyers and sellers compendium, and we used 9 tools here to come up with basically a combination of screens to find which screens find what stocks to be have the most multiple hits. So we used the Joel Greenblatt inspired screen, Intelligent Investor, and 7 others. And based on that, we see that the stocks that had multiple hits and also seem to be not as well, better positioned, also in the valuation and the consensus earnings screens are Hyundai Mobis, Kia Motors, W Games, Kakao Bank, KT Corp, Semco, NCSoft, and Lotte Shopping and Kakao. While on the other end of it, we have Celltrion, EcoPro, BM, Hyundai Department Store, JYP Entertainment, Koei, LG H&H, LG Innotek, Mondo, and Lotte Energy. So if you look at our sector allocation, we're still positive on the commercial services sector. We also are positive on the healthcare, industrials, and also some of the staples that are export names, which is not very different. And I think, from here, we have to look at 3 things. One is, when are we moving from late cycle to early cycle, as I mentioned before, and we think that will come after we get clarity on the politics and the tariffs. I think the second issue is going to be on the side of on the local side. What kind of policy do we see in terms of supplementary budget, domestic demand support? And I think the third element that we will have to look for is on the reform side. And as you may know, the commercial code has been passed by the National Assembly and has been actually transferred to the presidential office to get either promulgated or to be vetoed. And depending on that, we'll see how the whole reform theme presses forward. But I think for now there is some concerns that it could be vetoed. But and that's why I think the impeachment of case for President Yoon is actually quite important here. So I think for Korea, for first half, we did see that there could be a bit more volatility. But for second half, as we move through the cycle and we see a bit more clarity on these issues, we do think that there could be a bit more upside. So we're still kind of in a wait and see situation. Let me stop here and hand it back to Crystal.
Thank you very much, Jun. And then lastly, we're shifting to Indonesia because there is a lot of market volatility lately. So I will invite Selvi here to discuss her latest note on the stress testing Indo banks in the bear case. Over to you, Selvi.
Thanks, Crystal. So I'll cover the Indonesian bank. Let me just give an overview of what has been happening in Indonesia. I guess since late September last year, Indonesian market has seen quite a lot of sell-off, and particularly I think this sell-off has become worse year to date, and quite a lot of it was also due to the overhang after the change in the new government, and therefore we are still waiting quite a lot of just the uncertainties around policy, as well as the government has formed sorry.
Yeah, now it's clear now.
Right. Okay. Sorry for the technical issues. I think in terms of, I mentioned earlier, there are just quite a lot of overhang just in terms of the policies under the new government, as well as recently in February, the government launched investment fund, and therefore we are seeing quite a lot of wait and see, and as well as foreign investors are actually exiting Indonesia just to wait a bit. In our note, what we did was we did a stress test in our bear case, so as given that the overhang remains and we do not have a clear timeline yet as to when we should be thinking of adding a lot more in Indonesia at this point. What we did was actually we tried to see what will happen in our bear case. So in our bear case, we increased our cost of equity for the state-owned enterprise from 11 to 12% previously to 15%. And that's to take into account higher risk premium for the state-owned enterprise. At the same time, we also assume like uncertain economic policies or macro situations to impact loan growth. And therefore, we cut our loan growth forecast about 7% in the forecastable future, which is like the next 5 years or so. We also assume like revenue headwinds to remain challenging. And what it meant is that cost to income ratio for the bank will pick up. And lastly, we also look at the credit cost for these banks, and we assume like the banks will see another credit cycle just due to the different kind of a challenging macro or other types of lending related to maybe like some of projects which historically tends to see a bit more credit quality deterioration. And given all these situations, what we came up was actually a valuation for the banks. And what we are seeing in this case was we still see some downside to our bear case, which is 16% to 60% for the state-owned enterprise. And where we are positioning at this point is we remain cautious in Indonesia. We actually prefer the more defensive private banks BCA, given that, in the year to date or in the past few weeks, we have also seen some outflow from BCA. But I think that's the reason was because of the positions of foreign investors, which tend to be overly positioned in BCA, and therefore, given the situation, BCA also saw some outflow. But in any case, we still think that BCA is one of the main where we are more comfortable in Indonesia. And other than that, we also prefer Bank Rakyat. It is also a state-owned enterprise, but the reason why we prefer BRI as compared to the other SOE banks is because they do have a niche business model, which is a micro-financing business. And therefore, we do see them to continue to be able to defend their market leadership and be able to maintain their ROE despite the uncertainties. Where else, we think that valuation for the Indonesian banks are actually have fallen quite a lot, and we maintain equal weight on these names. But as I mentioned, we remain cautious in this name. And also like these weeks, the past 3 days, the banks have concluded their AGMs. We did see a couple of management changes among the banks, in particular BRI and BNI, whereas at Mandiri, the CEO was reappointed. We will continue to engage with the management just to see what is their business plan going forward. So I'll stop here and I'll pass it back to Crystal.
Thank you, Selvi. Now we'll move across to the Q&A session. You can submit your questions by using the Ask a Question text box. We have several questions for Robin on China. So the first one is on tariffs. In the new forecast, how much tariff impact have you priced in? And then are we expecting further escalation on April 2nd targeting at China? And how do you expect the US-China trade talks to unfold this year?
Thank you, Crystal. So we have 25% cumulative tariff in our model since November last year. But frankly speaking, now within only 2 months of the Trump administration, we already got 20%. So a lot of things has been front-loaded to first quarter right now. And of course, there is a risk of further escalation after April 2nd. That's why I do believe tariff is stickier and higher for China. and it's harder for China to negotiate down. But the policymakers' reaction function will remain, number one, on countermeasures to the U.S. It will remain measured. It will remain symbolic. That's something different from 2019 because they don't want to see escalation. Secondly, on domestic stimulus, they will keep that reaction function in a reactive manner. So it's not preemptive. That's why we kept saying you need to see downside surprise from sequential growth from housing and the consumers to trigger the next stage of stimulus. And the late July policy bureau meeting could be a good time window. But to get things sustainably reflated, like nominal GDP and GDP deflated to a much firmer footing, they need to deliver not just the short-term vouchers or subsidies, but longer-term, deeper social security reform. I believe the recent talks about the social benefits for the poor people, plus the National Fertility Support Program, is a good start. But initially, the size might be small, not enough to reflate the economy in a sustainable way. So we need to work.
本音频素材为 B 站小白投资笔记防盗班音频。
Thank you, Robin. I think you have partially answered the second question, but I'll just ask this anyway. Do you think China's recent growth trend will sustain and broaden now? And what will make you more bullish and see more upside to both real and nominal growth?
Well, that's a very important question, but you can see it from our title of the GDP revision note. Revising up growth, keep on a moderating path. So that means that we still see sequential growth may start to soften from second quarter onwards. And policymakers will remain in a reactive manner. However, I think comparing to September last year, definitely things are in a better shape. They start to provide a debt relief program, start to emphasize the importance of consumers, and there is a partial return of animal spirit in the tech sector. All of these are showing at least if there are bright spots in tech, in CapEx momentum of sophisticated manufacturing sector. Despite it's not enough to decisively reflate, I think it is in a better shape than 6 months ago.
Thank you, Robin. That's super clear. I think that's all the questions for China. And then we will take one last question for Selvi on Indonesia. So how did the AGM's outcome yesterday impact our sentiment on the banks?
Thanks, Crystal, and thanks for the question. In terms of the sentiment, as I highlighted previously, we did see a CEO change at BNI and BRI, whereas at Mandiri, the CEO was reappointed. I do think in terms of the continuity of business plans or business strategy, Mandiri definitely given the CEO was reappointed, and therefore we don't see risk there. Whereas with regards to between BRI and BNI, we do see less risk at Rakyat. The reason is despite the CEO change, we also think I think they are very focused on microfinancing, and that's also one of the focus area for the coming government to help the lower income group. So I think they will be able to defend the positions. And I guess lastly for BNI, we will see with them what are their plans, but they did mention that they will continue the transformation process. I think just one point to highlight, the banks also announced a much higher payout ratio as compared to what we are expecting as well as to the street. In terms of the dividend payout, the high dividend payout ratio, well, it will mean that I do think that will provide a near-term support just in terms of dividend yield, because now we are looking at about 7 to 9% kind of dividend yield or maybe slightly higher. And therefore, I do think that will be taken positively. But at the same time, we want to watch out for the commitment level for the management just in terms of maintaining the right buffer of capital. And the reason being that I think there is a lot of I think there is a view that with the formation of the investment fund in Indonesia, there is an inclination to actually pay out more in terms of their dividend from the SME companies. I'll stop here. Thanks, Crystal.
Thank you, Selvi. And in the interest of time, we'll conclude today's webcast here and answer the remaining questions offline. If you find this session useful and you want to join our other series, or go to the Asia Research landing page on the portal for a collection of the region's most important research and our audio video series. Thank you for joining, and do reach out to me and the team if you have any other questions. Have a nice day.